Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Lease and SBITA, or Subscription-Based IT Arrangement Accounting for Tribal Entities. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, today's presenters are Surek and Javier Moreno, both senior managers here at Moss Adams. Now I'd like to turn it over to Lauren to get us started.
Thank you, Amy. I'm Surek, a senior manager in the Tacoma, Washington office, and I have been working with tribal casinos and entities for about 10 years.
Hey, good morning. I'm Javier Moreno. I am a senior manager as well, and I'm out of our Phoenix office. So like Lauren, I've spent the majority of my 18 years in public accounting serving tribal casinos and business enterprises. I'm just excited to be able to present this morning on these 2 rather significant new accounting standards. But with that, I will turn it back over to Lauren to get started with the presentation.
All right, so we'll first go over our learning objectives. After this presentation, you'll be able to describe how the new lease standard changes the accounting for both lessees and lessors. So in other words, we're going to go over GASB 87. And you'll also be able to describe how the new subscription-based IT technology arrangements standards changes the accounting for those such arrangements. So we're going to go over 96. We'll also be able to identify the accounting and disclosure requirements under these 2 new standards. Quick update on our agenda. We'll talk a little bit about the standards themselves, and then also go through some tips and tricks that we have from seeing some of our clients really implement these standards, hopefully help you with your implementation process. And hopefully at the end, we'll have some time for some Q&A, so please use that Q&A feature to send us some questions. And with our first polling question, Amy, I'll give that to you.
All right, thank you. So the first of our 4 polling questions is, how prepared do you feel to implement GASB 87 and 96? A, I've already adopted one or both standards. B, I've started preparing but have a lot more to do. Or C, this webcast is my first step towards preparing to implement GASB 8796. And we will give you a few moments to respond. To respond, you will need to click the button next to the answer you choose and hit the submit button. And if you can't see the submit button, you will need to enlarge your slide area. I do see some responses coming through the Q&A window. So if you would like CPE, you do need to respond directly on the slide itself. All right, here are the results.
All right. Just kind of as I was expected, a lot of the BC area, and that's totally okay. We've got some time, but hopefully this presentation will be helpful in getting your feet wet in these standards. All right, so now we'll talk a little bit about the scope, terms, and overview of the standards themselves. First, we'll go over GASB 87, as this is the first standard of the two that's required to be implemented. Basically, the foundational principle is that all leases are now financing leases. So gone is the terminology of capital versus operating and all of that analysis you're used to doing. They'll all be presented on the balance sheet as financing leases. Basically, this is because in a lease transaction, the lessee has been receiving the legal right to use the underlying asset and makes payments for this legal right. So basically, this means that the lessee has financed the acquisition of this right, and the GASB has decided that these should be considered as financing. And then conversely, the lessor receives payments for the right to use that asset over time. We're going to have a handy table that you can use as a reference later that more clearly shows the nature of the resulting assets and liabilities on both sides of these transactions. But also please note that a lot of the framework we're going to talk about in GASB 87 is also going to be applicable to GASB 96. Luckily, there's a lot of similarities that we can leverage off of in understanding both of these standards. So that is kind of one silver lining on both of these. And next, we'll talk a little bit about the timing. So GASB 87 is applicable for reporting periods beginning after June 15th, 2021. So in other words, that means it's your June 30th, 2022 year ends, which is in a couple weeks, September 30th, 2022 year ends, and December 31st, 2022 fiscal year ends. Another part of this is that adoption should be applied retroactively by either restating all prior periods, if that's practicable, or at least reporting a restatement of beginning net position for the earliest period restated. So you do actually have to look back to 2021 as you're adopting this if you are presenting multiple years. The leases should be recognized and measured using the facts and circumstances that exist at the beginning of the period of implementation, or if you're applying to earlier periods, the beginning of the earliest period restated. And you're not going to restate the assets that you have under current sales type or direct financing leases. The residual assets for these are going to become the new carrying value. So really the first thing that we need to understand is what is a lease. The standard defines a lease as a contract that conveys control of the right to use another entity's non-financial asset as specified in the contract for a period of time in an exchange or an exchange-like transaction. So we really want to break down this definition into 4 elements because they're all really important to really understand, to make sure what you're looking at is a lease. The first element is it a contract? It has to be a legally enforceable contract, but it can be written or verbal. Whichever one is a legally enforceable contract is applicable to this standard. And then second is the concept of control. We're going to talk about this in the next slide a little bit more because this is a really important part of this definition. It also has to be for a period of time. It's not for any perpetual agreements that are never ending. And generally that period of time has to be longer than 12 months. Also, the contract has to include an exchange or an exchange-like transaction, so both parties have to give and receive equal value. One instance that we see a lot in tribal governments is the transfer of the right to use an asset for some nominal amount, like maybe $1 a year. This is not going to meet this definition of an exchange or an exchange-like transaction. And so the GASB believes that this type of contract is more like a non-exchange transaction or like a donation or a grant. So you're going to go to GASB statement number 33 for that guidance. That's the statement that covers accounting and financial reporting for non-exchange transactions. So again, those really nominal amounts that aren't true exchange-like transactions are not going to be scoped into this definition. Another consideration is that it needs to be a legally separate entity. In GASB's implementation guide, they gave an example of a fleet of vehicles that a government owns. If the capital assets are reported on an internal service fund for different departments within the same legal entity, that's not also going to be considered a lease by this definition because it would be within the same legal entity. So also another thing to consider when you're looking at these leases. Going back to that concept of control, control of the right requires both of the following: the right to obtain the present service capacity from use of the underlying asset and the right to determine the nature and manner of use of the underlying asset. So what does this really mean? It means that you have to be able to actually use your asset. So for example, if it's a building, you need to be able to go in there, access it, do what you need to with it, maybe rearrange things, of course in the confines of the contract. And you need to be able to just control the way in which you're using it. So one reason why they added this notion of control is to help in differentiating leases from other types of contracts. For example, a supply contract like a power purchase agreement, which provides the right to purchase the output of a power plant, is going to be scoped out because you don't actually have control of the power plant asset itself. You're just getting the output. You don't have the ability to go in and dictate how the power plant is being run or operated. So that's one really important factor to consider, is what is the asset you're actually controlling. If it's not the asset itself, then it wouldn't be scoped into the standard. We'll talk a little bit more about items that are scoped out in the next few slides. Another important component of the standard is what is the lease term, because this is also going to be very important to understand. You're going to start with any of the non-cancelable periods in your lease agreement, and then you're going to add or subtract periods covered by options to extend the lease or terminate the lease if they're reasonably certain of being exercised. You'll also exclude cancelable periods. So this is an important one. So for periods in which both parties, the lessee and the lessor, both have the option to extend or terminate, effectively making it a rolling month-to-month lease, those periods would be canceled and not included in this lease term. But again, it's really important that both parties, the lessee and the lessor, both have that option in order to disregard that period. Another kind of tricky thing is that the standard does not define reasonably certain. So that's going to require management judgment on what is reasonably certain for the extension or termination of a lease. Auditors, of course, and anytime there's a management judgment, are going to ask for documentation of why that conclusion was reached as well. So that's why it's going to take a little bit of thought and documentation around some of these lease extensions and termination options. To talk about that a little bit more, as you can see, the judgments about what's reasonably certain might greatly impact the lease term. So the standard really gives some helpful guidance on what you should consider, but again, they're all going to be very interrelated, and it's not kind of a one size, or you can't hang your hat on one of these things. You really have to think about the lease likelihood in general to determine if you think that you're likely to extend or terminate the lease based on the options provided. A couple of things to consider is, are there significant economic incentives to extending the lease? For example, are you getting a really favorable rate compared to what you would get in the market? Then that's going to likely play into your decision to exercise those options. On the flip side, if there's a significant economic disincentive, like a cancellation penalty, big relocation costs, or if you put a lot of leasehold improvements that you're going to have to abandon, or even if you have to return the asset to a certain condition based on the lease, and that's going to cost a lot of money, that's definitely going to be part of your consideration as well. Also looking at the history of exercising the options and the extent to which the asset is essential to provide your government services. So if that asset is really needed to make these services seamless and it's going to cause a big issue to have downtime, that's also going to be part of your determination. What this also means is that there might be some reassessment of the lease term. So when you originally accounted for the lease, if you thought, we'll definitely extend the lease, but then when you get to that period, you don't, then you're going to have to do some changing to your accounting to account for those factors and that change. So that is going to happen, but you can only kind of do your best guess at the time of the implementation. So another thing to consider is short-term leases, less than 12 months are excluded. So a couple things we wanted to talk about with lease term is that one thing we've seen a lot of is long lease terms having a big impact on this accounting. So we have seen intra-entity leases, like for example, casino, the land that the casino or the C-store is sitting on, leased by the tribe. These can have really long terms and a lot of options to extend. So it might be like a 10-year lease that has another option for another 10 years. If there's no tribal plans in place to move that casino or the C-store, or if you really think that those are going to be around in the next 20 years, you're likely going to have to include those into your accounting. What that means is that even if you don't have a super material monthly payment, when you apply that over 20 years and take the net present value, it could really change the consideration on if that's material or not. And in some cases, it can be a really big dollar amount. So that's really just important to kind of think about is when you have these really long lease terms, how they might impact the asset and the liability. Also, kind of going back to the short-term leases, we see a lot of people kind of hoping to hang their hat on that, which does make sense. We see it a lot in gaming machines for casinos. You talk to your slot department and they say, oh, definitely we can get out of these leases anytime. They're all less than a year, which very well might be the case, but really actually reading the contract is going to be critical. You want to make sure that if you think it's under a year, that there's not like a master agreement overriding some of these individual agreements that says a longer period. You also want to make sure that if you're saying, oh, we can get out of them at any time, that both parties, the lessee and the lessor, have that option, not just the casino itself. So those are just two things that hopefully you can scope a lot of these out, but you really do have to read the contract to make sure that that is the case. And to talk a little bit more about what is scoped out of the standard, leases of intangible assets, biological assets, inventory, those are scoped out. Contracts that meet the definition of service concession arrangements are also scoped out, and you'll go to GASB 60 for those. And also leases in which the underlying asset is financed with conduit debt. Supply contracts like that power purchase agreement we talked about earlier, and then also certain regulated leases will be scoped out, as well as leases based on future performance. So I wanted to kind of stop here a little bit and go over some of the ones in bold, because we see a lot of examples of these in our tribal clients. Intangible assets are a big one. One thing is like natural resources. With those, you really want to make sure you, again, read the contract, because you want to decide what is the asset you're controlling. Is it the right to exploit the resources or the right to the land used to exploit the resources? So if you have the right to the land itself and controlling it, that is a tangible asset and it would be scoped in. But if you only have the right to the resources themselves, then that would be scoped out. Another intangible is gaming rights, like slot allocation agreements, terminal allocations. Those would be scoped out because you're not leasing the slot machines themselves to another casino. You're leasing the right to operate a slot machine. So that is an intangible asset. So luckily we have a lot of those in our clients, but those would be scoped out as well. Software and maintenance fees associated with gaming machine agreements will also be scoped out. One caveat here is they might be scoped into GASB 96. Javier will talk about that later, but at least for this first standard, they'd be scoped out, as well as sports sponsorship agreements. So if you kind of sponsor a sports team and you get advertising and perks and things like that, since there's no control over that team or any of the assets there, that would also be called intangible. Biological assets are also scoped out. Again, going back to that element of control, is it the crops or the crop land that you're truly leasing?
Same with grazing rights and hunting rights. Really looking at that contract will be critical. And then the final item we really wanted to talk about was the leases based on future performance. Again, going back to gaming machines, you might have a lot of contracts that are related to future performance of that machine. So based on a percentage of revenue, you're going to pay that vendor. If that's strictly the case, then they'd be scoped out because that's all variable based on future performance. But it is important to read the contract to see if there are fixed minimums required. If there are those fixed minimums, then that portion would be scoped in. And you'd actually have to then track that portion separately in the variable payment that you're making on top of that minimum, which would still continue to be expense. So it can get a little tricky when it comes to those contracts. And another example of a future performance type of agreement would be maybe if a tribe leases a building or a casino leases space in their food court to like a McDonald's or another food vendor. If their payment to you is just based on the future revenues of that McDonald's, then you can scope it out because there's no fixed element. But if there is a minimum payment, then that minimum again would be scoped in, and you have to keep track of the variable element on top of it to expense that portion. So again, that can be a little tricky as well. And now we'll go to our second polling question. Amy, I'll give it to you. All right, thank you. So the second of the 4 polling questions is the following are scoped out of GASB 87 except A, lease of inventory, B, intangible assets, C, biological assets, or D, IT hardware. And then also just a reminder, you can submit your questions for the presenters in the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards.
Lots of things are scoped out, luckily.
I believe I did see a question come through regarding the slides. So just a reminder that you will have access to these slides after the presentation.
Lots of material, so it'll be good to have those handy. All right, looks like most people got it right, IT hardware. So the software would be scoped out, but the hardware would be scoped in. A little bit of a trick question because the software will be maybe scoped back in GASB 97 or 96. And so it looks like a lot of folks got it right. But again, you don't have to get it right to count toward your CPE eligibility. All right. One thing, someone mentioned a Coke and Pepsi contract. I've seen those, and I think those would probably be, I would say, intangible, because usually it's the right for Coke or Pepsi to be your main supply agreement. So that's what I've kind of taken the stance. Again, you'd have to read the contract to see if there's a tangible element of it, but I bet there would be a good portion that if they're just giving you the right to be your sole provider of soda drinks, then you would call that intangible. That would be my take on it. Now I'm going to hand it off to Javier, and he's going to go over the fun part of accounting once you've done that scoping process.
Thank you, Lauren. So let's jump into the accounting for these lease arrangements from both the lessee and the lessor perspective. Before I do get into it, I do want to mention that Moss Adams did put on a previous webcast where we did go into a little bit more detail on the debits and credits of this accounting treatment, and we walked through some examples. So if you weren't able to attend that webcast or you're interested in a little more detail, then we will provide a link to that recording at the end of this presentation, along with some links to some additional guidance that the firm has put out. So let's begin with the accounting from the lessee perspective. So after you've gone through and you've determined that the lease does in fact meet the criteria, then at the commencement of the lease term, the lessee will need to recognize an intangible right-to-use asset. And this is measured at the value of the lease liability. And then this does get adjusted for any prepayments or additional direct costs or incentives. A corresponding liability will then be recorded, and this is recorded as the present value of future lease payments. So one important element of this calculation is the discount rate that's used in the present value calculation. So one thing that we've noticed for clients that are currently working on implementation or that have early implemented, that this discount rate, this is generally the most difficult item to come up with and to support. So we'll discuss this in a little more detail on the next slide. And then the third element for the lessee, and this is usually performed monthly in conjunction with making the lease payments, is that the asset will be amortized. And like all other capital assets, it's going to get amortized in a systematic and rational manner over the shorter of the lease term or the useful life of the underlying asset. So then moving on to the lessor side, it was GASB's real intent for the lessee and the lessor accounting to be as symmetrical as possible. So while the lessees and lessors are not required to communicate and mirror the accounting, the guidance was set up to make the treatment as equitable as possible. So one important element of this is intra-entity leases. These are leases between tribal entities. Because this is a very important element that could have a significant impact on the accounting, we'll discuss this in a little more detail on a separate slide. So then for the lessor side, at the commencement of the lease, the lessor will record a lease receivable. And this, like on the lessee side, is recorded at the present value of the future payments to be received. They will also continue to report their leased asset and record depreciation on that leased asset. Next, they'll recognize a deferred inflow of resources, and this is equal to the lease receivable plus any cash that's received up front, assuming that cash relates to a future period. And then lastly, the lessor would amortize the lease receivable discount to interest revenue, and then the deferred inflow would be recorded as revenue over the term of the lease. So one item that I believe Lauren mentioned earlier is related to remeasurements of the lease agreement. So if there are significant changes to the lease terms, interest rates, or the length of the contract, you will need to remeasure this accounting at the time of those modifications, which likely means you would have an adjustment to your receivable or deferred inflow if you're the lessee, and if you're the lessee, the asset or the liability. So let's talk about the discount rate from the perspective of the lessee. So this is the area that will likely prove to be the most challenging. So there's really two elements, two options here. The easiest is the implicit rate in the lease. So if all leases had a stated implicit rate, that would be the easiest determination. Unfortunately, in most cases, there is no stated rate. So in that case, you would move over to the second option, which is the lessee's incremental borrowing rate. And this incremental borrowing rate is where likely the judgment and estimate will occur. So there's going to be a natural tendency to just immediately use the same rate as any debt that you currently have on your books. But there's a few considerations that need to occur, before concluding that this is the appropriate rate to utilize.
Yeah, and this is an area we've seen a little bit more of a hiccup than we initially thought was going to happen. Again, like Javier mentioned, there's often not an implicit rate. So if you either don't have debt to look at for your incremental borrowing rate, or if your debt isn't at all comparable to the asset you're leasing, like for example, if you have like a really low line of credit interest rate and you're kind of trying to apply that to maybe a building or a land lease, there might be some pushback on if that makes sense, if that's a kind of equitable market rate for that type of lease and that type of asset. So definitely might want to get some different parties' input on what rate you're using, because like I mentioned, there's been a lot more robust discussion than we originally anticipated around this discount rate concept. So one thing to look out for.
And then for the lessors, The discount rate, it can be just as challenging. So again, if there is an implicit rate, you would likely use this. And I think in certain cases, we've seen clients start to include an interest rate on their future lease agreements in order to avoid this issue. But in most cases, the leases likely won't have an implicit rate. So there's a few ways to come up with the discount rate if there isn't an implicit rate. The first being the lessee can compare the fair value of the underlying asset that's being leased, and then compare that fair value to the present value of future payments to be received to come up with the actual discount rate. The lessor may also use their professional judgment based on some observable information. They could use for instance, the lessee's estimated borrowing rate or some sort of a published borrowing rate. So again, at the end of the day, with discount rate, this is going to be where your focus is definitely going to land, your interaction with the auditors. A lot of judgment will come into play when determining the discount rate. So let's talk about financial statement disclosure requirements, and we'll start with the lessee side. So in general, as with most significant lease transactions that have historically been in place, we'll need to disclose the description of the terms and the general information about the leases. It's going to be important that you make sure that you're able to separate the lease assets as well as the corresponding accumulated amortization from all of the other capital assets that are on your balance sheet. You'll be required to disclose them separately. And within these leased assets, you're going to need to disclose them. You're going to need to disaggregate them by major class of the underlying leased asset. You'll also need to disclose future lease payments as well as any related party leases, which that's really not a significant change from prior disclosure requirements. It's likely you've disclosed your related party leases. And the other item I want to make sure to point out is that you will need to disclose payments incurred during the period. But one of the tricky items is that you'll need to disclose variable payments that were not previously included in your initial measurement of the lease liability. So for example, going back to the slot participations that have a daily fixed rate, but that also have a revenue share component that's based on a net win or some sort of future contingent performance, you will need to disclose the variable and the fixed payments incurred. So it will be important to keep track of both the fixed and the variable payments on these types of arrangements. And then on the lessor side, it's very similar requirements in that you'll need to disclose key terms of the leases, the assets, the deferred inflow that's recorded, including any variable payments that were initially excluded from the receivable. And then again, you'll need to disclose the related party nature of any leases, as well as future payments that are expected to be received. All right, so let's go on to polling question number 3.
All right, so our third polling question. I anticipate the following will have the biggest impact on my entity's financial statements. A, lessee accounting and related disclosures. B, lessor accounting and related disclosures. Or C, I have both. And then also as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
I see a question in the Q&A about if it requires a lot of work if you're a lessor, and there is some accounting for lessors as well. I think at first, it was like, oh, we mainly focused our conversations on the lessee side of things, but the flip side of having that receivable and the deferred inflow for the lessors is also definitely part of this standard. Like Javier mentioned, they are hoping that they mirror each other as much as possible, But we do understand that sometimes, that's not possible, or there's not clear communication between the two parties. And it's not required that you communicate between the lessee and the lessor to make sure they're mirroring each other, but it is definitely a requirement of the standard.
All right, here are the results.
All right, so it looks like the majority either have both or on the lessee side, which I think is pretty consistent with what we're seeing. All right, so let's move on to GASB 96. So as I think we've previously mentioned, there is some good news on this standard. A lot of the work that you have or you will put into the implementation of the lease standard, it will support your implementation of GASB 96. The standard utilizes a lot of the same framework that we've previously discussed, the similar accounting. So whereas GASB 87 related to the physical, tangible asset or hardware, GASB 96 relates to the software component. So GASB 96 is the accounting for subscription-based information technology arrangements. Long name. And let's talk about the effective date. So it is effective for reporting periods beginning after June 15th, 2022, so today. It will be your fiscal year 2023 if you're a June 30 year end, a September 30, or a December 31st year end. So likely your next fiscal year, your fiscal year 2023. And with this lease standard, it will require a retroactive adoption by restating all prior periods presented. So for those that are listening that are part of the tribal gaming operation, the NIGC does require comparative financial statements. And this also applies to GASB 87 for this year. So a dual year presentation is required. So you'll want to make sure that you gather the necessary information for the fiscal years that are presented. And then given the similarities with GASB 87, some entities are electing to early adopt 96 as they're going through doing the work for GASB 87. So early implementation, it might be recommended if your entity is entering into a new software arrangement where you meet the requirements of GASB 96 prior to the implementation date, or if you don't want to go through and have back-to-back years of retroactive implementation on your financial statement. But one item of caution, if you are considering early adoption, is to consider the relationship of your entity, fund or component unit of the primary government, and the impact that early adoption throughout the governmental organization would have. So it's important to know that if the primary government is early adopting, then this would require early adoption by all component units. So then what is a subscription-based IT arrangement? So it's essentially the right to use another party's IT software. And this can be in conjunction with the related IT hardware, or it can be on a standalone basis. So like GASB 87, the concept of control and being able to determine the nature and manner of the use of the asset is going to be key. It might be a little more challenging when we're talking about the IT side and what control is. With GASB 87, it's a lot more clear cut. When you lease a building, you're able to utilize the building, work out of it, and you can determine you have control. With the IT asset, you need to consider what control and access you have to the software that they're providing. So one thought that you can have as you're going through doing your evaluation is to ask yourself, so when our contract with this vendor expires, will we no longer have access to this software? Will our access get cut off and we won't be able to log in and utilize it? And if that's a yes, that might be a good indicator that you have a subscription-based IT arrangement. And these subscription-based IT arrangements, they've become really popular, in the last handful of years with the cloud-based computing and storage that a lot of entities are moving towards. So then one helpful way to assist in determining, whether or not you do have software that meets the criteria is to understand what does not meet the criteria of GASB 96. So let's start with standalone IT service contracts. So if you have an external IT support arrangement, they typically wouldn't be scoped in unless there's an IT system that's associated with this service that meets the criteria where you're able to control the manner of use of that software. There's other specific contracts that fall under the scope of GASB 94 and GASB 51. GASB 96 does not apply to tribes that provide the right to use their IT software and hardware to other entities as a pass-through, and therefore not the end user. It also does not apply to licensing arrangements that provide a perpetual license to governments to use the vendor's software. Those meet the requirements of GASB Statement 51. And then again, like GASB 87, there is an exception for short-term contracts. But again, you'll want to look at any options to extend in your analysis, to make sure they are truly short-term in nature. So then lastly, let's discuss the materiality aspect of the software. This doesn't necessarily mean that the software doesn't meet the criteria of the guidance, but materiality does play a key part in the judgment. So if the software is insignificant when compared to the tangible capital asset, it might make sense to scope it out. For example, a computer's operating system, which is insignificant to the overall cost of the computer. Going back to gaming machines, if the software component is insignificant to the lease slot machine, then it's possible that this could be excluded. But anytime you're dealing with the concept of materiality, you should establish a policy and then just apply that consistently over the course of all of your assets. And of course, anytime materiality is involved, definitely discuss with your auditors, ensure that, to ensure that it can truly be excluded and it's not individually significant or in the aggregate with other similar types of software. So then just real quick, as we mentioned, the framework, the significant provisions of GASB 96 are very similar to what you're going to analyze when you're implementing the lease standard. The length of the contract and any renewal terms, the discount rate, intangible asset, corresponding liability, similar disclosure requirements for the lessee, and then also the separation of multiple components of the contract when you're going through the evaluation process. And I won't get into too much detail on the subscription liability because the accounting is very much the same. But again, at the commencement of the contract, the liability would be recorded. And like GASB 87, start with the present value of the payments of the contracts and adjust for any specific variables. The discount rate is essentially the same as GASB 87, the implicit rate or the incremental borrowing rate. And then the amortization of the discount on the liability should be recorded as an outflow of resources, typically interest expense. And then on the asset side, you would start with the liability that you calculate on the previous slide, and then you would adjust for any additional costs or incentives. And we will go through these additional costs on the next slide. And then the subscription asset, it should be amortized over the shorter of the subscription term or the useful life of the underlying asset. So then let's talk about implementation cost. So this is one of the unique elements of GASB 96 compared to GASB 87. And this is largely driven by the lengthy implementation period for software. Think about a time where you implemented a new accounting system or an ERP system, and it likely didn't occur overnight. It was a long process from the initial identification of the need to actually placing the software into service. So along the way, it's likely that this project accumulated different costs throughout the process. So let's go through the considerations of some of the more significant costs at each stage. So beginning with stage one, the preliminary project stage. This is where you're determining your needs and evaluating the different technologies and vendors to determine ultimately which software will meet your needs. So these exploratory costs, these development stage costs, these should be expensed as incurred. The second stage of the process is the initial implementation stage. So when you've selected your vendor and you started the customization process, the initial installation, and the testing stages, you should start capitalizing these costs as an addition to the subscription asset, and you continue to capitalize these costs until the asset is ready to be placed into service. And then lastly, the final stage is the operational stage. So this is for costs incurred subsequent to the implementation and placing the asset into service. So these costs relate to maintenance of the system and other costs related to ongoing access to the asset. So generally, these costs are going to be expensed as incurred. Similar to your other capital assets, you're going to expense the maintenance costs unless the activity meets certain capitalization criteria. For instance, if you're adding a new significant component to the system or adding a new feature, that should be capitalized.
All right, so now that we've talked about the standards in more detail, we'll talk about a few tips and tricks we have for tackling this process of implementing the standard. We've seen quite a few clients go through this process, so we can kind of give a little bit of advice, hopefully. The first step we recommend tackling is gathering an inventory of leases. This is the process that we have seen take probably the longest amount of time and being kind of the most complicated portion. So if you haven't started this process, we would recommend that you start pretty soon in order to prepare for this implementation. You'll want to gather all of your executed lease documents and put them in some sort of systematic repository or an Excel schedule where you can identify the key provisions in your lease documents and have those handy and easy to read. The main takeaway that we want to discuss is that it takes a lot of coordination between departments. So we've seen that take quite a bit of time because finance and accounting typically can't do this in a vacuum. Usually it takes input from, we'd say, the slot departments for the gaming machine leases, about what machines are actually on the floor, what are we paying for, and then also what were the machines that were on the floor a year ago since we're restating prior period. And so that takes quite a bit of time is to just sifting through the current agreements. And then for 96, definitely talking to your IT department. What are we paying for? What systems are we paying for, and how do those work? Of course, starting also with your expense accounts, your GL, and looking through what are we paying for? Are there lease agreements attached to these invoices that we see come through? That's a great starting point. But we'd say definitely the main takeaway is just this takes some time and it takes some input from other folks. So that's why it can drag this out a little bit longer. Then once you have that complete list, you'll want to start scoping your leases. So hopefully what we talked about earlier today will help you scope some of these leases in and out. The next kind of element of scoping is establishing a materiality scope. So even if they do fall within the standard, when you have some of these entities that you guys have are really large, and so is it really worth everyone's time to account for a copier machine lease that is only a couple $100 for a few years? That's definitely something that should be considered. You might also want to bring in your auditors, like Javier mentioned, because they might have an idea about what's material and not. Also, you want to make sure that you know that it's not just the monthly payment being material or not, it's how that's applied to the term. So like we talked about earlier, if it's a 20-year term, that monthly payment might be significant. And so you really have to do a rough estimation of what that net present value of that asset would be to determine if it's truly material. And then on top of that, you also need to kind of think about how many are you scoping out because you're calling them immaterial, and in the aggregate, are they reaching that materiality threshold where it would be that you have to record some of them so you're not reaching that ceiling. So again, it's not super straightforward, and we also suggest probably putting together a policy going forward, because as you enter into new leases, it's going to be important to add those to your inventory of leases and really have a gauge on when we have one that's over X amount per month and X term, then we really need to look at this really closely. So this is a bit of a process in determining what materiality is appropriate for your entity. Then hopefully one silver lining is that once you've done that time-consuming process of scoping and gathering your list of leases, you don't have to crunch the numbers yourself, which is really awesome. There have been some really smart software engineers who put together these software packages that can help you crunch these numbers. So when you're evaluating what software might be useful for your organization, here's some tips and tricks we kind of have seen to be useful. The first and really important one is to make sure that the software is compatible with GASB 87 and GASB 96. And basically making sure that it's not a software that's just for FASB reporters. While the FASB and GASB standards are very similar, there are some differences in the way the journal entries are going to be popping out. So you want to make sure that the software definitely understands those differences and accounts for those. And you also want to look at what is the output that you're getting. Ideally, the software is pretty much doing it all for you after you've done that initial assessment. So it should be giving you your journal entries that you can record on a monthly or annual basis, whatever period you're thinking of recording these. It should give you your amortization schedules to help you in your reconciliations at month end and have some check figures. Also, it should also help you with your footnote disclosures. So those future tables, those future payment tables and things like that, hopefully that would be built in as well to at least get you started on the footnote. So anything it can do for you, try to get it to do that, because that's going to be really helpful going down the road. Also, how customizable is it? It should be able to really customize for your exact GL account, so that's what it's spitting out is something you can basically upload right into your accounting software as your journal entry. It shouldn't need a lot of manual manipulation by you on the back end. And can it report different reporting entities? That's also a really handy thing, because oftentimes, there's even different departments or entities within your organization that you want to have separate entries for. Hopefully, it can also do some document storage, so you could hopefully upload your lease straight to this software. And so it would be like, here's the journal entry for this lease, and here's why we put it in and identifying the key provisions. This would also be super handy for your auditors. If your auditors can be allowed read-only access to this software, then they can kind of poke around, look at which lease you're including and what the journal entry is related to that lease. And then hopefully they would ask you a few less questions because they can find the answer themselves. And then, of course, security and privacy, always important for anything you're putting your data into, so involving your IT department to make sure it meets those standards. And checking if the user interface is easy to use. You might have quite a few different levels of folks accessing this program, so making sure that it's easy to use and understand. And then also, of course, what is the annual cost? Is it by lease, or what is the pricing situation? One funny thing that kind of has come up is that if you enter into one of these, does that mean that is scoped into GASB 96? So now you actually have to put the leasing software on your books. Hopefully, it's a small enough cost that it's below that materiality threshold that you have established. But I did think it was pretty funny to have a leasing software that could also be scoped into the standard as well.
And I do want to add one thing here related to the software. I think it's definitely worthwhile to reach out to your auditors. So a lot of CPA firms, Moss Adams included, we looked at a variety of these types of tools, and we happen to have a software vendor that we've vetted that when our clients come to us, that we do refer them to, and they receive discounted pricing directly from that vendor. So obviously we maintain our independence. We don't receive any commission, and you work directly with the vendor. But especially if your entity has a significant number of leases, as a software, it's often charged on a per lease basis, then it might be worthwhile to inquire of your audit provider to see if they have a similar type of arrangement.
And then the last thing we really wanted to talk about, and it's definitely last but not least, is that one important factor that has had a significant impact on implementation is how to handle inter-entity leases. Many tribal entities have various assets that are leased between their entities, and how these are treated really depends heavily on the component unit determination. This is a really good time to revisit that original component unit determination and make sure it still is accurate and makes sense, because we've actually seen some robust discussion on going back to that original component unit determination and making sure it's correct. Because when you attach millions of dollars sometimes for these assets and liabilities, it really makes that come into play a lot more than we originally thought. Because like you can see here, if you have a lease with a blended component unit, eliminations are going to take place for internal leasing activity before the financial statements are aggregated together. Whereas if you have a discretely presented component unit, you're going to treat them like normal leases and present the receivables and payables as separate line items on the financials, and they will also be presented on the aggregated financial statements. And then if you have an enterprise fund, then you're not going to record the inter-entity lease on a standalone or an aggregated financial statement basis. So this really can have a big impact, and we've seen people kind of want to go back and really revisit that and make sure it's still accurate. So that is one big suggestion we have. And now we'll go to the last polling question.
All right, so our fourth question is, how do you plan to prepare for implementation of these standards? A, I'm going to get help from a software. B, looking at increasing the communication between departments to ensure all leases that are currently in effect are identified and accounted for properly. C, determine a materiality threshold, or D, all of the above. And then also, for those of you that would like a copy of today's slides, you can download them now from the folder that says slide deck and handouts. And then we'll also be sending them via email tomorrow along with the recording of this webcast. All right, here are the results.
All right, all of the above. We like to see that.
So then our final slide here, it's just a recap of everything that we've discussed, some of the more significant items that we've seen in helping our clients. I did see a question in the Q&A related to lease slot machines, whether or not arrangements with a flat fee or percentage of coin in or scoped in or out. So what I would do with your slot participation agreements, look at the terms, see if they are truly short-term leases, 12 months or less. If they are 12 months or less, both parties have the ability to get out. At that point, it does get scoped out. Beyond that, if there's a flat fee, it's likely, you will have to do the evaluation to be scoped in. And if it's purely based on coin in, then there really isn't a baseline where you can compute that present value. It's a contingency kind of exclusion there. But we have seen some that have both the flat fee and the variable. The important thing there is to track the cost, track the fixed and the variable costs for those for disclosure purposes.
Javier, I did want to jump in on one thing I saw come through the Q&A about our implementation cost table when you were going over GASB 96. We need to check what maybe it said about our preliminary project stage. Those should be expensed as incurred, and someone kind of mentioned maybe our table got mixed up that it didn't say that. So I just want to reiterate, when you're going back to GASB 96, the preliminary project stage cost should be expensed. before you select your vendor.
Correct. And these are costs associated with looking at the different types of software, you know, kind of determining what your preliminary needs are. Just your exploratory phase before you make the decision. Those should be expensed as incurred. And I think that's it. I think that's all we have time for today.
Yes, thank you. Unfortunately, we are out of time. If we didn't have time to get to your Q&A, we will do our best to follow up with you afterwards. And then also, thank you, Lauren and Javier, for a great presentation today. Our audience, you feel free definitely to reach out to our presenters if you have additional questions. Their contact information is in the slide deck and also in your console. And I also want to remind you that we have a lot of resources on our website. We have linked a few of them directly in your console, so definitely check those out. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 3 weeks should you have difficulty downloading it now. And finally, here's a link to an online survey where you can provide feedback for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.